Okay, so Chapter 8 is about fixed assets. Fixed assets are the tangible equipment, buildings, trucks, that sort of thing that get used in the business to generate revenue. They conduct the day-to-day activities. So if you're a manufacturing plant, you've got some great big equipment that's running in a warehouse. Not only is the equipment a fixed asset, but the warehouse is, any delivery trucks, the desks you have in the office, the computers you have in the office, those are all fixed asset sort of things. One of the things I want to talk about analysis-wise is, what is an efficient use of those fixed assets? Who makes better use of the assets between your two competing companies for your project? And I keep looking at the slide and it's throwing me off, but if you buy too many fixed assets, if you buy way more machinery for your factory than you need, say we could produce 1 million parts of whatever it is you sell, but you're only going to sell 100,000, you've wasted a whole bunch of money buying this equipment. So you're not being efficient with your fixed assets. You're not being efficient with your cash that you spent on it. On the flip side, if you only buy one machine when you need two to build 100,000 units, then you've missed the opportunity of more revenue. You could have sold more if you had added more capacity. So there's a fine line between the two, and we're going to talk about how to analyze that and look at how well the management team is managing the assets of the company. Okay? So, what are fixed assets? Those of you that had my 151A class, remember, they are actively used in the business. There's a difference between fixed assets and inventory. Inventory is the stuff that you're going to sell, right? Are you actually using it as part of your business on a day-to-day basis? No. It comes in, it sits because you intend to sell it to someone else. Fixed assets, on the other hand, are used day-to-day in your business. Anybody here have a job in an office? You walk in and you do what? You turn on the lights, you turn on the coffee pot, you sit at a desk, and you turn on your computer. So you got a coffee pot, you got a desk, and a computer. Those are the fixed assets that you're using on a daily basis. One thing to remember about fixed assets is they tend to be around longer than one accounting period. For example, if you've got a company and you buy a delivery truck, how long is that delivery truck going to be around in the business?
It better last for years.
It better last for 4, 5, 6 years, maybe more, right? So you're going to get benefit from it in more than the current accounting period. So we want to take that cost and we want to spread it amongst each accounting period that you're going to get to use it. Right? So say you spent $20,000 to buy a truck. How much of it did you use up in the current accounting period? How much do you use up in next accounting period and the one after that and the one after that? You want to split that cost of $20,000 up amongst each of those income statements. You don't want to expense the whole $20,000 in the current income statement. And we do that through something called depreciation. We'll get to that in just a second. Just to point this out now, because it's on the slide, everything I've talked about so far, buildings, equipment, trucks, computers, desks, those are all what are called tangible assets. You can actually pick them up, touch them. There are things called intangible assets. Anybody give me an example of an intangible asset? Patents. Anything else? Trademark. Yep. Brand name. Exactly. So those are all assets that can be acquired that have value over a long, long period of time, and they're referred to as intangible. They have no physical substance. You can't touch them. Okay? So, categories. Land is a type of asset, fixed asset. Buildings are a different type. Furniture and fixtures. The other one that I didn't mention, natural resources. If you are in coal mining, gold mining. Somebody's got the gold companies in the group. Gold mining, things of that nature. You have a natural resource that is an asset to your company. And with things like building furniture and equipment, we use something called depreciation to match the expense, the cost of that asset with the revenue it generates. With natural resources, it's called depletion. So as you use it up, you expense part of it. On the intangible side, trademarks, goodwill, patents, copyrights, and some people don't think of it, but franchise fees. If you have a franchise, in this book, one of the examples they use is Papa John's Pizza, and they franchise a lot of those. They're not owned by Papa John's, but Papa John's gives them the right to use their name and all the technology that they, the recipe is what I'm trying to think of. The recipe and things like that. Other franchises that are well known, McDonald's, KFC, all of the fast food stuff. Anybody think of any others? No? Okay, good enough. But some of those sometimes have a definite life. If you get a patent on something, how long is a patent good for? I think it's only 14 years, right? And if you buy a McDonald's franchise, maybe you only bought one that's good for, 20 years or something. I don't know that for a fact. Sometimes that's the way they're set up. What?
They renew.
Or you can renew them, yes. Yeah. So, one of the ratios, analytical ratios that I want to focus on, fixed asset turnover, net sales, not gross sales, divided by the average fixed assets. Remember, just like we had average inventory before, beginning plus ending divided by 2 gives you average. Good? Yes, ma'am.
Net means
gross sales, less discounts, returns, allowances.
fixed assets. That's including,
I'm sorry, I misspoke. Average net fixed assets. What does that mean?
It includes the depreciation.
You back out the depreciation first. So if you've got $200,000 worth of assets and they've been around for half their life, your accumulated depreciation is $100,000. $200,000 minus $100,000 to derive net fixed assets. Okay? In this example, they're using Southwest Airlines. Interesting choice, because what are their fixed assets? Airplanes. And they're really cheap, aren't they? Yeah. So they had net sales revenue. Notice they've obviously lopped off several sets of zeros here. I'm sure this is $10,350 million or something like that. So 10,350 divided by beginning assets plus ending assets divided by 2 gives you 0.96. Now, how do we analyze the ratio? Notice in this particular year, it's older data, it's 2008. Southwest in 2008 had a number that was 1.01. Are we doing better or worse in the current year? Worse? Why? Exactly. Is Delta doing better or worse? What? Oh, I thought you said worse. I apologize. And United is doing? Better. So if you stop and look at this, what we're calculating is how many sales dollars did we generate for every dollar of fixed assets that we have. Okay? Hell out of that. Okay. Let's talk about, that's the ratio that you want to use to analyze and compare your competitors and compare your own company from year to year. So if you're looking at like a 3 or 4 year trend, is your own company doing better or worse? The other thing I want to talk about is the cost of your fixed assets. when you buy fixed assets, the cost gets what's called capitalized, and it ends up going on your balance sheet under property, plant, and equipment, and then we have land, buildings, equipment, and so on. The value that gets capitalized is sometimes not just the price you pay for the item. For example, if you buy a piece of equipment and you have to pay to have it shipped to your factory, that gets included in your capitalized cost. If you have to pay to have it installed, that gets included in your capitalized cost. If you have to pay to have it modified, that gets included. All those things get included in your total cost of that piece of equipment. And the basic concept is it's everything it takes to buy it and get it in place and in service. And by in service, that means the guy who runs the machine can walk in the morning, push the button, turn it on, and start making parts, whatever the parts are that you sell. Okay? Questions on that? Okay, so with buildings, you start with a purchase price, right? You go out and you buy a building, and if you bought a building that was a foreclosure or something like that, and you have to go in and do a bunch of repairs to it, that gets included. Or if you go in and you are, Cisco, those guys go in and buy buildings and they gut the whole building and they redo the whole inside of the building. All of that is part of your cost of the building. Whatever it takes for you to get it the way you need it to go in the following morning, turn on the lights and go to work. Okay? When you go through the actual purchase, if you end up paying any legal fees or pay a realtor or something, that gets included. Title fees. Anytime you transfer a piece of property, there's always some sort of title fee where the escrow company charges you, and there's title transfer taxes with the county, things like that. All those things get included. Good? Okay. Equipment, like I said, we'll just fly through this. Purchase price, installation, any modifications you did, delivery costs to get it to you. We just talked about, we talked about buildings, but if you buy land, the same sort of thing applies. Purchase price, real estate commissions if you pay any, legal fees if you pay any, if you have to pay to have it surveyed. If you bought a property that was in foreclosure and you have to make up the property taxes for some reason, or if that's part of the agreement, that gets included. Remember I said we use something called depreciation to match the cost of the asset with each accounting period where it generates revenue for us? Land is an exception. Land never depreciates. We never depreciate it. We never take the expense on it. Why is that? Say a little louder.
Because land doesn't lose its value with time.
Land does not lose its value. Okay? If you buy a truck and you drive it for 200,000 miles, what do you have left? Not much. If you buy a building and you occupy it for 100 years and you don't do any significant improvements to it or repairs, what do you have left? Something that's probably going to fall over, right? There's ongoing costs associated with keeping it up and keeping it nice. If you buy a piece of land and let it sit there, does anything happen to it? Barring that earthquake where it falls off into the ocean, it's going to be there forever. So we don't expense the land. Okay? So in the homework, when we're doing these, there will be questions where you'll buy a building with some land and you have to split up the two pieces so that you depreciate the building but not the land portion of it. Okay? There's my hint for the night. Questions?
Say that again.
That was a statement. If you buy a building and a piece of land, you have to allocate costs, the cost of the building and the cost of the land, and you set the land aside because you never depreciate that, but the building you depreciate. You don't just take the whole total amount. Oh, I bought a building that sits on a piece of land. You don't depreciate the whole thing because you're not depreciating the land part of it. So you have to separate them out. Other questions?
Are they always,
whenever you buy a building with land, do they separate them and buy, or do you have to do it?
No, you have to do it. In the real world, you have to do it. In the homework problems or on the test, I'll tell you.
Okay, but how, in the real world, how would you do that? How do you determine how much the land is worth?
Well, you can talk with your realtor, you can get an appraisal done on it, and it's, what is the land by itself worth, and what is the building by itself worth, and you can make an allocation based on, again, you're making an estimate that's an educated guess. Okay? Yes, ma'am.
How does that relate when, like, the neighborhood becomes delinquent? And so the value of everything goes down.
Okay.
So,
But when you buy it, it's a single point in time. So you're going to have a price at that point in time, right?
right.
And if you're saying it, the neighborhood goes into decline and values aren't what it used to be, what do you do? Is that the question?
Yeah. So if you go to sell and it's not, like the housing,
When you go to sell, it's an easy answer because you have a gain or loss when you sell. Okay? If you've got, you've got a fixed asset that you're depreciating over time in the building, and you're going to continue to depreciate those original costs against the revenue you generate from it. You're not going to recognize any loss on it until you sell it. Okay? Or if you get into if you get into liquidation where you're going to liquidate the whole company, then you're going to be looking at these things, or liquidating it as a segment of the company. We've talked about extraordinary gains and losses, right? If you liquidate the segment of the company, it's going to become extraordinary, and you're going to have a gain or loss for it at that point. But again, you're selling it. Okay? Other questions? Okay. So, a couple of examples for you, and I want to show you the journal entries because it's easy to follow what's going on. Southwest Airlines, remember, because those airplanes are cheap, and this information's got to be out of date because I know these things are more money than that nowadays. You got to feel pretty good about it, though. You get on an airplane, you're going somewhere, and if the airplane cost $100 million, odds are you're going to get there, right? Because they don't want it to fall out of the sky. It cost them a lot of money, yes? Okay. So here Southwest goes out and they bought a piece of equipment. So equipment is our asset. We're going to debit the asset. What did we give up to get the airplane? Cash. Is this a reasonable example? No. Why?
That's a lot of cash.
Who has that much cash sitting around? Exactly. Here's another twist on it. They bought a $75 million aircraft, so they debit equipment. They credit cash. We had to put $1 million down, and we promised to pay the rest of it, $74 million, over some period of time. Okay, this is kind of like you or I going down to buy a car, right? You got to put some money down, and you end up making payments on it. Okay? This is much more common. This is a hybrid of paying cash and financing part of it. Good? Questions? Okay. If you pay for something, and this happens, if you pay for something with a non-cash method of payment. So for example, somebody, if you buy something very expensive, will give up their own company stock in exchange for it. You go and you take the market value of whatever it is you're giving up, and you record that as part of your payment. So in this example, Southwest is, they went to Boeing, they bought a $75 million airplane, and they're giving them, hang on, $25 million in cash, and they're giving them 1 million shares of stock in Southwest Airlines. So all of a sudden, Boeing becomes one of the owners of Southwest Airlines. Okay? So if you On the date of the transaction, the market value of the shares was $50 a share. There's something called par value. We haven't talked about par value yet, have we? Yes, we have? Okay, you always record your common stock at par value. So if we gave up 1 million shares, we're going to record our common stock at $1 million par value because it's $1 per share. The rest of it goes in additional paid-in capital. Good? So you've got equipment, still that debit for $75 million bucks. Credit for cash for what we gave up, $25 million in cash. Credit to common stock for the $1 million par value, and the rest, the $49 million bucks, goes in additional paid-in capital. Good? Questions? Anybody?
Why is it recorded in that order? The common stock and then cash? Because...
No reason.
Okay.
Okay? I probably would have done cash first, but it isn't going to make a difference. The same amounts are going to get posted to the general ledger anyway. Okay? Other questions? Yes, sir.
So paid-in capital means current market value minus common stock value?
No, let's be careful there, because you said current market value and common stock value.
Minus.
And those kind of mean the same thing. The word is par value. Par value is the stated face value of the share, and it's printed on the stock certificate. Typically, you'll see stock certificates with $1 par value. I've seen 10 cents. I've seen a penny. I've seen 10 bucks. Typically, you see either a dollar or a penny. So you record the par value, the stated value, to common stock, and anything between stated value and market value goes in additional paid-in capital. Okay? Questions on that, anybody? Yes?
One question I have.
Okay, go ahead.
So this is just like the purchase price of the plane.
The purchase price was $75 million.
So on the, like a couple slides back, though, you were talking about how included in the acquisition cost, is like the purchase price and then any repairs or installation costs or whatever. So
Right.
when you record it like in the asset, do you do it in pieces, like as you expense out the different costs that you're putting out, or do you?
Great question. Typically, you do a subschedule where you take the purchase price and then you list all your installation costs and you do a build-up and you come to a total number. So in this example, our assumption is that total build-up came to $75 million. Okay? Maybe this was a deal where we bought this from Boeing and they delivered it to to the San Jose airport for you, and they parked it on the runway and gave you the keys and said, here, you're done. So it was a delivered price. So we didn't have any of those other things built into it. Okay?
But if you did, you would record it.
You could record it in this entry, yes. Yeah. Okay? Other questions? Yes, ma'am.
Why would they want shares?
Maybe it's a form of financing to them. It's a publicly traded company. They could go out and sell those shares, or maybe they, feel that the company's going to do well and they're willing to make an investment and take a little bit of a risk to see if they can make more profit off of it. So they could have an investment gain from it, or loss. But it is another form of financing. If you're selling stuff to a very stable, long-running company, the stock price may not fluctuate much, and they feel, okay, it's good enough. The other thing that could go down in here is, any kind of bank financing, like we saw on the other slide here, where it's a note payable. So there could be a third party, a bank involved, or some other finance company. Okay? Yes, sir.
So if a large company purchases another corporation in the United States, would that made that with 1 million shares increase the value of the stock the next day when it becomes known? And is that part of the formula?
It may or it may not. The stock could go up, the stock could go down. You don't know how the market's going to react. But on the day the transaction closes, you use market value. Okay? So I'm trying to think of an example and I can't, but that's all right. If you've got one company buying another and they're paying for it with their own stock, you're going to use market value on the day it closes.
That'd be a consideration to someone who's just one person buying stocks to find out who else owns those shares.
Right.
Boeing just bought $1 million, that would may encourage the person who purchased more stocks.
Correct. Mm-hmm. Okay. There's another thing that we haven't talked about. Sometimes a company will build their own asset. An example here would be if you've got a very, very specialized piece of equipment that you need to run your factory, maybe you're going to build it yourself. Or, if you're somebody like, KB Homes, they're construction guys. Maybe they will build their own corporate headquarters or something like that, right? I don't know that they did it, but I'm trying to come up with an example for you. When you do that, you still have acquisition costs of the asset, the fixed asset that you end up building. And you've got to keep track of the internal costs within your company and allocate them to the project. So if you build your own corporate headquarters, you're going to go out and buy, lumber, sheetrock, all kinds of, concrete, bunch of construction material. So you're going to pull all that together and you'll keep it, rather than expense it, you're going to keep it in an account so that you can capitalize all of that when you're done. You'll need a temporary holding account to do it. You're also going to have some overhead. Let's use the example when we're building a piece of equipment. We need a very specific piece of equipment for the factory that we run. Maybe, it's a steel mill or something, and they're building their own whatever it is. So if you take 10,000 square feet in the corner of the factory and you spend 6 months building this new piece of equipment there, not only do you have to track all the time for your employees and your labor costs and all the parts that went into it and the gaskets and the steel and all that stuff, but you've got to allocate some of the overhead. If you're paying rent for the building, you've got maybe 10% or 5% of the building's rent should be allocated to it. Some percentage of the utilities for the lights and the power that you use for the welder and things while you're building it, stuff like that. And the third thing that gets added into your cost of your self-constructed asset is if you go out and you borrow money to actually do the construction, you need to include the interest expense during the time while it was being constructed. If you still owe the money afterwards, the interest expense afterwards doesn't get capitalized. It goes into ongoing interest expense as you're paying off the rest of the loan. But during the construction period, it gets added to part of your original cost of that asset, and that becomes the full amount that gets capitalized. In our example a few minutes ago, it becomes that $75 million number. Okay, you were first.
Does this count for, is this like if you're expanding, your campus or whatever, but you're not literally building yourself, like your employees are not building it, you've contracted out to a contractor to build an extra building, do you still do it the same way?
No, they're sending you a bill with one total at the bottom and you're paying it. Okay, but if you're constructing something yourself, you're doing all the work of bringing in the parts and the labor and all of the elements and putting them all together. So all we're saying is you have to record all of that and bring all those together to calculate your total cost on the project.
Okay.
Okay?
So if it's the other way, where it's like a third party doing it, then it just goes like how it was before, where it goes into just the...
Yeah, if I'm Cisco and I go to, like San Jose Construction, build me a new building, they're gonna send me an invoice. And the amount on that invoice, that's my number. Okay? Yes, ma'am.
What if it takes a really long time? Do you still keep it in the temporary account and not make it an asset?
Yes.
Start depreciating until then?
Now, I used a term here that may have confused you. I used the term temporary, in conjunction with account. Remember, we have permanent accounts and temporary accounts. Permanent accounts are balance sheet, temporary are income statement. Well, as long as it takes you to build this, if it takes you 2 years to build it, I use the term temporary, but it's really a balance sheet account. It's going to temporarily sit on your balance sheet account, and it will be called construction in progress, new building. So before you start, that account will have a zero balance, and when you're done and you move into the building, the entire balance will get moved to the building account on your balance sheet. So it'll have a zero balance when you're done, but it does reside up in your balance sheet part of your chart of accounts.
During construction.
Yes.
What would be, can you give us an example of the journal entries for that? To see what the...
When it gets moved? Sure.
Well, when you're building it.
Okay. So you've got, and I'm going to do them in T accounts just to make it easy, okay? So you've got this account that's construction in progress. So let's say you go out and you buy $10,000 worth of lumber. You pay somebody $100,000 to come in and pour the concrete foundation. You pay somebody to, you pay your workers to put it up. You buy some other, doors and light fixtures and some other stuff. Okay, and let's say you're all done. Let's make it an easy example. So I've got $170,000. All said and done, and my building is done. Tomorrow we're going to go move in, so I need to capitalize this. You're going to credit this account, and you're going to go to your building account, and you're going to do it in the same color so they match. And you're going to debit that. So now you've capitalized it, and the ending balance of your construction in progress account is zero. Hence the reason why I called it a temporary account, even though it could be there 2, 3, 4 years. Let's hope not.
What about all the expenses that you had to pull out of the building? Where did they go? Did they go into actual expenses?
No, instead of posting this to an expense, or your wages to an expense, they get posted here instead. So they don't affect your net income. Right? Because we're going to have the use of this asset. It's a building. It's going to be around for 30, 40, 50 years.
So what I'm saying, while it's getting built, I mean, we're supposed to have a debit, a credit for a debit. Where does the $10,000 go?
Okay. What was this? I went out and bought
Somebody
lumber, right?
Lumber.
So let's say I paid for it in cash. My credit is to cash. I paid the concrete guy. My credit is to cash. I paid my employees. My credit is to cash.
So there's nothing goes into expenses then?
Nothing hits an expense account. You're accumulating all of those costs so that you can capitalize them in your building account and then depreciate this over the useful life of that building. Good? Questions? Anybody? Yes, sir.
What does the word capitalize mean?
Capitalize means that we recognize it as a fixed asset and we park it on our balance sheet as, in the property, plant, and equipment category. And we recognize that we're going to get the benefit of that over many, many, many accounting periods. So we capitalize it so that we can then use the depreciation system to match the expense with each of the many, many accounting periods that we get the benefit of it.
So that's a transition to make it part of the company's capital.
Correct.
Before that, it wasn't. Now it is part of the company.
Let's be careful, because capital is a specific word that refers to stock. Okay? So it is part of the assets of the company. We're going to capitalize it into the assets of the company. Okay? Other questions?